What if the AI revolution that's powering America's hottest stocks today ends up being the biggest economic mirage since the dot-com crash, leaving trillions in smoke and your retirement account in ashes? Hey folks, welcome back to the channel where we cut through the hype to deliver the real economic story. I'm your host, and today we're diving deep into the AI boom. Savior or bubble? In the first half of 2025 alone, AI-related investments drove a whopping 31% of US GDP growth. That's not a typo, folks, 31% from chips, servers, and data centers alone. That's more than consumer spending, the usual engine of our economy, which makes up 2/3 of GDP. Harvard economist Jason Furman dropped a bombshell last month. Without those AI data center buildouts, GDP growth would have been a measly 0.1% in the first half of the year. Investment in info processing gear and software? Just 4% of GDP, but it accounted for 92% of the growth. We're talking a turbocharge that's got the S&P 500 up 25% year to date, Nvidia's market cap rivaling entire countries, and tech giants like Microsoft, Google, Amazon, Meta, and Nvidia leading the charge with a combined $320 billion in capex pledges for AI this year. But hold on, is this the dawn of a new golden age, or are we inflating a bubble that's gonna pop and drag the whole economy down with it? By 2030, PwC projects AI could add $15.7 trillion to the global economy, $6.6 trillion from productivity gains and $9.1 trillion from juiced-up consumer spending. IDC chimes in with an even bigger number, $19.9 trillion cumulative impact, driving 3.5% of global GDP that year, with every dollar spent on AI generating $4.60 in broader economic ripple effects. McKinsey's in the mix too, forecasting $13 trillion in added global output by 2030, a 16% bump to cumulative GDP. Sounds like a no-brainer, right? Frontrunners in AI adoption could double their cash flows by decade's end, per McKinsey, implying 6% annual net growth on top of business as usual. Let's break down why this could be America's next big economic engine. First off, productivity. Goldman Sachs estimates AI could juice US productivity growth by 1.5 percentage points annually over the next decade if adoption goes wide. That's huge. Think back to the internet era, where productivity gains averaged 2.5% a year in the late 90s. Dallas Fed economists peg a more conservative 0.3 percentage point boost, but even that could add thousands to GDP per capita by 2050. Penn Wharton models it out. Generative AI alone could lift total factor productivity by 0.2 percentage points at its peak in the early 2030s, compounding to a 1.5% higher GDP level by 2035 and nearly 3% by 2055. We're already seeing it in real time. JP Morgan reports AI capex added 1.1% to GDP growth in the first half of 25, outpacing traditional drivers. And it's not just theory. Goldman Sachs crunched the numbers and figures AI has already tacked on $160 billion to true GDP since 2022, even if official stats undercounted because of import-heavy spending. Zoom in on the infrastructure frenzy. Data centers are the new oil rigs of the AI era. Renaissance Macro Research says their build-out has surpassed consumer spending as a GDP driver for the first time ever, adding about 100 basis points to real growth. Tech behemoths are pouring billions into this. Oracle just committed $3 billion across Germany and the Netherlands for AI cloud expansion, on top of deals with OpenAI that could see $30 billion in annual revenue by fiscal 2028. Oracle's OCI is tailor-made for AI, embedding native database tech into hyperscalers for killer performance. Nvidia is dropping up to $100 billion into OpenAI for next-gen models, while Meta's CEO Mark Zuckerberg talks hundreds of billions for massive AI data centers. This isn't pocket change, it's reshaping sectors. Healthcare? AI's forecasting models like Microsoft's Aurora are boosting accuracy by 24%, potentially unlocking $200 billion in value by 2030. Finance, logistics, manufacturing, all getting efficiency shots in the arm that could mean cheaper loans, faster shipping, and leaner factories. Now, the job angle. Yeah, it's scary, but the data's more nuanced than robots are coming for your desk. World Economic Forum's 2025 Future of Jobs report projects 92 million roles displaced globally by 2030, but 170 million new ones emerging, a net gain of 78 million. Back in 2020, they nailed a similar call, 85 million gone by 2025, but 97 million created, netting 12 million. Goldman Sachs pegs US displacement at 6 to 7% of the workforce if AI goes full throttle, but it's transitory. Unemployment might tick up 0.5 percentage points during the shift as folks reskill. High-risk jobs? Customer service reps, 80% automation by 25, data entry clerks, 7.5 million axed by 27, retail cashiers, 65% at risk. But winners? AI ethicists, prompt engineers, data annotators, roles that didn't exist 5 years ago. Remember, 60% of today's US jobs didn't in 1940. Tech creates more than it kills. St. Louis Fed data shows unemployment rising fastest in AI-exposed fields like software dev, up sharply from 22 to 25, but blue-collar gigs with low AI applicability are holding steady. BLS is baking this into projections. Database admins might see slower growth from AI tools handling code gen and analytics, but demand for data infrastructure keeps employment humming. The opportunity side shines brightest in innovation. AI is not just automating drudgery, it's sparking breakthroughs. Google's AI co-scientist is cranking out hypotheses and research proposals, accelerating discoveries in biomed and beyond. Half the 2024 Nobel in Chemistry went to DeepMind's Demis Hassabis for protein folding AI. Imagine what that's unlocking in drug development. PwC says 45% of AI's gains by 2030 come from product enhancements that rev up consumer demand. For your wallet? Lower costs across the board. Think AI optimized supply chain slashing grocery prices or personalized meds cutting healthcare bills. IMF forecasts a 0.5% annual global GDP lift from 25 to 30, with the US leading. If you're in tech-savvy spots like Silicon Valley or Austin, this is your rocket fuel. But let's pump the brakes, because the bubble warnings are blaring louder than a fire alarm. Bank of England just flagged a growing risk of a sudden correction in global markets, thanks to frothy AI valuations. OpenAI is now valued at $500 billion, up from $157 billion last October. Anthropic tripled to $170 billion in months. Forbes is sounding the all clear. This could wipe $40 trillion off the Nasdaq if it pops, dwarfing .com losses, with $1.5 trillion in AI data center debt by 2028 and 95% of enterprise AI pilots flopping. Echoes of 2000? Telecom laid 80 million miles of unused fiber. Today's AI capex is 1.2% of GDP, matching railroad mania levels. Reuters notes opinion split, but constraints like construction bottlenecks are real. ABB's CEO says no bubble yet, but supply chains can't keep up. IMF's Pierre-Olivier Gourentes compares it straight up to .com. Hype driving valuations, cap gains fueling consumption and inflation, but a bust could trigger sentiment shifts and asset repricing, stressing non-banks. Not systemic like '08, but painful. Think 2.7% CPI and 25 sticking higher if spending dries up. Yale's Jeffrey Sonnenfeld warns of dangerous overinvestment. OpenAI's $300 billion Oracle Compute pledge over 5 years, $60 billion/year, against $13 billion 25 revenue? That's a black hole. Cross holdings amplify it. OpenAI stakes in AMD, Nvidia pouring $100 billion into OpenAI. Microsoft owning chunks while renting from Nvidia-backed CoreWeave. It's a house of cards. PitchBook, 2/3 of US VC deal value in H1 25 went to AI/ML startups, up from 23% in 23, exuberance on steroids. And the risks aren't abstract. Challenger, Gray and Christmas tallied 10,375 AI-linked layoffs through July 25, 1.3% of total cuts, but climbing in tech hubs. SSRN Research, 76,440 jobs already vaporized this year, with manufacturing, 2 million at risk by 30, and trucking, 1.5 million. Next. Budget Lab at Yale sees no surge in AI-exposed unemployment yet, but the mix is shifting faster than during the internet boom. If adoption stalls, say, from regulation or energy crunches, the rebound could mimic .com. Survivors like Amazon thrive, but the wreckage is brutal. Reuters warns a pop would hit the real economy hard, via equity wipeouts and capex pullbacks, not just Wall Street. Derek Thompson at The Atlantic calls it, numbers don't add up, AI usage dipping at big firms, momentum-driven stocks, over-engineered finances like subprime 2.0. So, where does that leave you? If AI's the savior, diversify into AI enablers, cloud plays like Oracle, up 378% in 3 years, still room to run with Stargate JV's $500 billion Gen AI bet, semis like Nvidia. Reskill now, learn Python, data ethics, or AI governance, those scarce skills command premiums, per PwC. Bullish case, we're on track for that $15.7 trillion windfall, with US GDP per capita soaring as productivity unlocks abundance. But hedge the bubble, keep 20 to 30% in bonds or defensives, utilities, consumer staples, cause if it bursts, Volatility spikes. Watch VC flows. If AI funding dips below $192.7 billion, early October record, that's your yellow light. Customer concentration? Nvidia's leaning heavy on a few whales. And policy, tariffs could front-load spending, then slam imports. Bottom line, AI's no fad, it's rewiring everything, from your Netflix recs to cancer cures. But betting the farm? That's bubble territory. Play smart, stay informed, and remember, the winners from .com weren't the hype merchants, they were the builders who outlasted the crash. What's your take? Is AI boom or bust for your portfolio? Drop it in the comments, smash that like if this sparks some thoughts, and subscribe for more no BS econ breakdowns. Catch you next time, stay savvy out there.